In this lecture, Professor A.K. Enamel Hawk explains how the invisible hand of the market works and how to define goods.
That an economy consists of household and farm. Remember, this was what we have discussed. That economy consists of household and farms. And we also realize that there is a market for product, and there is another market, which is a market for factor. And purchasing decision happens on all sides. So these people supply here to this market, and these people demand from this market. On the other hand, these people demand from this market, product market. So they demand goods and services, and these people produce and supply to this market. So remember how market is determined. Market is a process of exchange of, and that's why we always say the market is an exchange of goods and services. And there are certain functions of a market. So what market does? So what is the role of market? What does market do? One of the fundamental jobs of the market do, it clears demand equals to supply. So it makes, obviously, it determines price. So markets, one of the functions, and the most important criteria is that it is a signaling mechanism. So it provides signal to producer and to consumer what to do and how to do it. So it's a signaling mechanism. That is why you find out that Adam Smith, one big economist, his idea was the market has invisible, it has a concept called market has an invisible hand. So his idea was the market has a hand that you never know, but it gives you a signal. It's a signal that is provided in the market and everyone receives it. So for example, during right now, if you think carefully, during the COVID, market is providing certain signal. It's already giving a signal to the producer what to supply and what not to supply.
Right, sir.
Right. So they will say, look, supply this and do not supply this. So this signal is happening. Now you don't know your customer, but it's already providing a signal. Based on this, the economy starts moving. Somebody is investing. Remember, there are people who are investing also, right or wrong? Those who are
Yes, sir,
making,
absolutely.
yeah. So there are certain product investment and there are also disinvestment. Some certain areas that people are saying, forget about it. So all this signaling is happening through the market. And the interesting point is, even though there are buyers and there are sellers, they don't know each other. There is no direct connection between them. The connection is through the market. So Adam Smith mentioned that market is like a pulse of human body. And it's a signaling mechanism. It provides a signal. So if you look at the market, if the price started going up, over time, it's a signal. So if the price of a product goes up, it provides a signal. If the price of the product goes down, it also provides a signal. So remember, these are signaling mechanisms. So if I watch a market and if I see this type of a signal, just let me draw it. If I see this type of signal, what does this signal tells you? Now it looks like a more or less pulse rate, and it's telling that average price, the trend of the price is going
Upward.
up for whatever product you are talking about. If the signal is like this, so let me change the color. So if the signal is like this, what does it tell you?
Yes, the price is going
That the
downwards.
price of the product that you are talking about is going down. And based on this signal, producer takes decision and say, look, remember, producer has to take decision earlier than the consumer. They have to invest. So they take decision on this. And Adam Smith always mentioned that do not tamper with the signal. What does it mean, do not tamper? Do not distort the signal. If you distort the signal, then I have no idea what is going to happen. In other words, those who are receiving signal, who are watching the signal, they will have a fully, the idea that they will receive is completely wrong. Based on the wrong signal, they will make investment decision, which will be bad. And they will disinvest, which is also be bad. So all the decision that you do, production decision, of investment or production decision. So all this you do, you will be making a mistake. And that is why he's always thought that market has an invisible hand. And his concept was to not distort it. So what I want to know, and this signaling mechanism is nothing but price. So what I want to show that how the market moves. So let us look into it. And this is most of you have seen it, so I'm not going to spend much time, but I'm going to draw it for you because some of you may not have seen it before. So we start defining a market and we said how the market provides a signal. That's our target. So imagine this is the quantity and this is the price. And we have already seen that there are two parties. One group is known as consumers. So consumers demand, and we'll come back on this one. But the standard economic theory, which is not part of this course, is that demand is downward sloping. What does downward sloping means? Downward sloping
decreasing.
That not decreasing. It says if you decrease the price for any product, there will be more people to buy.
Oh,
so if the price goes down from P0 to P1, demand will go up from Q0 to Q1. So in other words, the formula that the theory that we say, which is known as a demand theory, it says that if price goes down, demand goes up. And if price goes up, demand goes down. So it's a standard human behavior known as the theory of demand, or some people say Texas law of demand, which I do not agree, but this is theory of demand, it's a demand theory. And this relationship, because they're opposite, is mathematically known as a negative relationship. So the relationship between demand in this case is quantity. So the quantity of product that I buy is negatively linked to the prices. On the other hand, if, for example, people income, and this is the theory of demand, so let's think about, so we now realize that demand, which is quantity, is a function of price. And this is something that realize that relationship between price and demand is negative. The theory of demand, and we are looking at it, the theory of demand also says that there is a relationship between price and income, demand and income. What happens when income goes up? What do consumers do when their income goes up?
They consume more.
Sure?
Income goes up.
Is it sure? Is it true?
They spend more, sir.
Spend more, but demand for a commodity. Remember, demand quantity is for commodity I. So this is like one product. So it depends on the product. If this is a black and white television, if your income goes up, you will buy more black and white televisions. People will buy more. So not necessarily. So realize that yes, for some product it is positive. For some product it is negative. So if income of the consumer goes up, you may find out demand graph shifts down. and we're defining as another price, and which means for the same price, demand goes down. So this is a negative relationship, and this shift has occurred because income has gone up. There may be another product. Let's say this is instead of so let me write down a different product. Let's say this is color television. So as people's income go up, the demand will go up, even if the price remains exactly the same, which means for the same price, there will be more demand. Okay?
Right.
So there will be more demand. Okay? So for the same price, your demand is going up. This is your net demand. Your demand is moving up, and that's positive. And why this has shifted? This has shifted because income has gone up. So income going up may lead to positive relationship or lead to a negative relationship. So this is something that we should realize, that income and demand has both positive and relationship. An economist has given a name for that. They said if it is positive, it's known as, it has a name, it's known as normal good. For most of the product, this is true. And if it is negative, it is known as, so I'm using the jargons. So when we use the word inferior good, we are not saying it's a bad good. It's not a bad product. It's a good product. Black and television is not a, black and white television is not a bad product. It's a good product. But because income has gone up, people demand less. So this particular relationship is known as inferior product. And the concept of an inferior product is that you consume less. So inferior product means quantity. Look at the relationship between income and demand, and this is negative. And normal product means if I look at the relationship between income and demand, relationship is positive. So remember this is how the normal good and inferior good is. So we are classifying, we're using the jargon, said, look, how do I define products? So now if I'm a producer, remember you are all producer. And if you are producing a product, and if you are selling a product which is called black and white television, and if our per capita income goes up, it actually means that you are probably going to find less and less customers. So something that we should be aware of it, and that's exactly happened to theoretically to Nokia. So if you look at the Nokia story, idea was very simple. Nokia was selling their products and targeting the developing countries, the poorer countries, created a fantastic product, very good product, does not break, very long lasting. They thought the poor people should not change their product very often, so they produced a beautiful product. However, as poor countries' income has started going up, remember the growth of the income has been happening not in the richer country, much higher rate in the poorer country. And as our income has gone up, what happens? People moved away from Nokia, even though it's a good product. So remember how income can significantly affect a company's decision making if you are not aware what type of product you are selling. So if you are a producer, you should be aware that am I selling a product which is a normal product, or am I selling a product which is an inferior product? If it is an inferior product, I should be aware that the demand is going to shift. So let me go to bring another concept. So we are writing the same demand function. And we say demand function is a function of price, and price is mostly negative. Demand function is a function of income, and income is positive and negative. And we said, how about price of another product? If I'm using the set theory notation, this is the price of other product. Means something else that I'm going to buy. That is all I need to know, nothing more than that.
Please subscribe to this channel to receive updates on new videos.